when you when you have a correction that's too deep, when you have a really, really deep correction, and as we showed you in Pictures Worth $1,000,000, you always want to compare the price action of a stock to not only its peers in its group, but to the overall market. What's going on? Is this real? Is this abnormal weakness? Is it outperforming the market? For instance, this stock right here, which was Mankind, this stock comes off 60% during a period where the NASDAQ only corrected 6%. So you had this little pullback, this very normal pullback in the general market, but Mankind comes off 60%. Now it comes ripping back up here. And right here, you can see, you could outline a VCP, but this right here, this contraction, if you will, is 25%. That's not single digits. That's way too deep. And that's why it fails. It failed miserably because you just didn't get the tightening. There's still lots of supply there. All that volatility tells you that there's a lot of supply. And then even here, I know some people call this a cup with handle, this big base here, and then call this the handle, but the handle was 20%. So you can't have a handle in 20% or a pivot in at 20%. That's a base. It's just too deep. There's too much volatility. So it never got a chance to really tighten up. And sometimes these will actually emerge. They'll come out, but they'll run into supply very quickly because they haven't had a chance to go through that natural ringing of the towel. And now look at the decline, how this just runs into huge selling. So you got to be really careful when you have the deep corrections. Another one that was I got a lot of questions on back in 2015 was GoPro, 2014 and 15, when it came out of a new issue. It was ripping higher, and everybody was talking about it. And then it cratered. It went down 61% during a time where the NASDAQ was actually up 10%. We talk about underperformance, 71% underperformance. This is the complete opposite of alpha, which we'll have to come up with an acronym for the opposite of alpha.
Well, one thing, Mark, that I found helps people is think of it in the context too of, because we get a lot of questions about stocks with big breaks or a lot of supply to the left. It just means there's a lot of folks underwater. If you think about that from a psychological standpoint, they're in pain, they want out. So that's sitting over the top of the stock. Anybody who bought this stock, is GoPro above 60, once it makes that break, they're all underwater. So it comes back up, and these are going to take more time, and they're just massively more failure prone.
So, okay, let's talk about that for a second. That's a good point Mark's bringing up. So first of all, you've got lots of supply. To the left, you have lots of supply. There's lots of people with losses. So as that stock comes back, and when you have a really big decline, there's inevitably going to be some bottom fishers, as it comes back and it marks back up, you get a large gain. All right. And the faster it comes back, the quicker these people start getting, back to break even, and these people get as we showed in the previous chart, get profits, and you create that selling, of course. But there's a lot of supply here, and with this big decline, it not only creates supply, but something's not right. Again, I mean, if a company's doing so well and the management's so good, right? We talked about differential disclosure. The management's good. The earnings are great. The sales are great. The profit margins, it's a great industry. Everybody loves the name. Why is it down 61% when the market's up 10? It also increases the odds that something's wrong. See, this doesn't make sense. There's no such thing as a good company. Even a good company, if it's in a downtrend and it's being sold off, Facebook's a good company. It's a sound company. Right now, it's down 75%. You're going to have to make a pretty big gain. If you're buying that now, you got a long way. Or, I'm sorry, if you bought that, up at the highs, because it was a good company, or bought it maybe when it first came down, you're sitting at a huge loss, and you got a long way to make that up. And you'd be one of those people that would create supply in the stock. So when you get that big decline, it also saying that something's wrong, especially if it's doing it during a time where the market isn't correcting. And so this is just a clear warning that you've got a faulty base here. And sure enough, it runs right into supply once again and can't rally. What you'll see this too is when you get into later stage basis. So you'll get the VCP, you'll be in a stage 2. This happens to be Decker's Outdoors, DECK. I was buying it right here, coming out of this base right here, and then you see it made a very orderly move up. And this is this is a logarithmic scale, so the moves percentage wise are the same. So now you can see pretty big base here, right? But comes out nice and tight, moves up nice and tight. If we were to put those dots on here like we did on those previous charts, you'd see all black dots. These are all new highs, all-time highs. Then suddenly you get the big break. Now the stock comes off, 50, 60%, and it still forms that big, couplet handle VCP, but this is faulty now. We're late stage. We've already gone through a number of VCPs and base breakouts, and see how nice and efficient this is. But then all of a sudden, the volatility starts picking up and it gets wider and wider. And that's where you start topping. That's how you identify stage 3. The volatility starts picking up, and you don't want to be anywhere around the volatility. When volatility picks up, that's not your friend. That's your enemy. And that means there's a lot of supply, because now you've got all these profits that have been built up in this stock, and now you get the unwinding of those profits, and that creates a lot of supply. All right, let me show you something here. So we're going to talk about, I'm going to get a little more, we're going to zoom in a bit more and take a look at what we call the pivot point. Again, you can go back to Jesse Livermore. He termed pivot points. He was using pivot points a little bit differently than I use it. But again, yes, he is I think the grandfather of pivot points. I've been using the term pivot points and using pivot points for the better part of 35 years or so. I want to show you exactly what we're looking for, and where we're buying, and get a bit more forensic here. Now, if you remember, I showed you that chart, a couple of charts. It was Monster Beverage, I think Microsoft, Yahoo, the dots, right? The dots were the new highs, or the all-time highs, actually, in this case. So what we want to do is we don't want to sit in the stock while it's moving sideways, or you have that volatile period. We want to be in the stock when those dots are being strung together. So we've got these techniques and tactics to get on board, and of course, this is at least what we're attempting to do, is to get on board as the stock is getting ready, or is just about to go into that up move, and you're going to start making those highs and making that big move. And you can see here where you string all the dots together. This is where we want to be in here. We want to be out here. We want to be getting ready right here. And then again, now you go through another digestion period. And once again, we don't want to be buying in here and going through all this time. We could be moving the money into something else and compounding that money. We want to wait until the stock starts moving. So again, as I said before, we're not looking for the lowest price. We're looking for the right price. And the right price is the price at which we buy, and very quickly the stock moves, even down. We even want, even if the stock's not going to work out and we're going to get stopped out of it, we want it to happen as fast as possible, because the sooner it stops us out, the sooner we can move on to something else. But we want to sit in there for 6 months in a stock, and then it stops us out. Now we've wasted 6 months. So, and if it's working, we want to be at a profit as fast as possible. So we've got that cushion. We can go through the pullbacks and maybe even take some shorter term profits along the way.
Just want to add to that, Mark, too. One of the things you'll hear us talk about is the idea of weak and strong hands. We're weak hands, and that last slide's a good example of how you want to try and be the last weak hand. So as the train is coming in on schedule, you're jumping on right as it's trying to move. And to Mark's point, if that thing stalls coming out the gate, you just step off. That's the beauty of this entire strategy. When it's really being performed at a high level, it gives you that ability to jump on the train and not have to sit there and wait and wonder, is this thing ever going to move? You should know what to expect ahead of time, and then it just allows you much better efficiency of your capital.
Yeah, let's once again talk about and define how we're a weak hand. We are weak hands, and proudly. So a weak hand is someone who is going to sell, easily, quickly, if the stock moves against them, or sell or they're not holding for the long term, and they're not going to add to the position if it's down. Like a mutual fund will go in there and buy the stock, and when it comes down, they'll buy more. Those are strong hands. That's supportive supportive demand. Me, I'm going to buy the stock. If it doesn't take off right away and it goes against me, I'm getting the heck out of it. So I'm a weak hand. So if, let's just say, let me get a little arrow here. Let's just say right here, I buy here. Well, a weak hand, this pullback right here is probably going to knock me out because I'm a weak hand. So, but if I buy here, if I buy right here, and I'm using PowerPoint here, so if I buy it right here, well, I can be a weak hand because it just goes right into profits. I don't have any pressure on me. There's no loss. So that's why we're doing it the way we do it, because why we're weak hands is because that's how we manage the risk. That's how we create asymmetric leverage. By having, let me put another, this is something I'm kind of doing off the cuff here. But let's just say here, by having this upside, that potential, okay, see, get that out of there, having that potential, but capping the downside, just say, we buy at that point there and we cap the downside, and our stop, we set our stop here, put that in red. So we've created asymmetric leverage. You see, we've got all this upside, but our downside is much less. And that's how we create the asymmetric leverage. So in order to do that, we have to be a weak hand, at least relatively speaking. But so by being a weak hand, timing is essential. Timing is essential, and that's the point Mark was making. Let me move on. I want to show you what these look like, what these pivot points look like, and then we're going to show you the different sort of floors that we have opportunities to get on board within the base. Remember, I said that we're buying within the base. So there's a number of areas that we will buy within the base, and I'm going to show you those. But the first and the easiest to identify is when the pivot point sets up very close to the 52-week high or the all-time high or the high of the base. So here you can see very tight. This is very clear. You're going through tightenings, iterations, super tight here. I mean, the volume difference, you couldn't see much more of a contrast. My God, look at this gigantic volume bar that comes. And this actually came out on a gap, but I think the day before, take that out. Yeah, the day before it broke out. So that's right there is where you would have actually bought right there. This is one that I did not buy, but it was a really great example that I was actually watching at the time and passed on it. I think it was going into earnings. I think that's what that gap was, if I remember. So here's another one. Here's CBPO, China Biologic. Now, again, 4 iterations going through the VCP, and again, they look a little bit different as far as, they're not exact. But if you take a look at this, and you take a look at this one's a little longer, maybe a little shallower, but same exact thing taking place where you go through these tightenings, the volume tightens up on when the breakout, the volume comes in. Here's VIVO. Now, sometimes these pivots, just because a stock is, well, I should say it this way, you don't have to have a stock go into new high ground for it to be a breakout, all right, or have the buy point. As a matter of fact, most of the time we're buying a little bit lower than the all-time high or the 52-week high. It's not going into new high ground, or it's coming off of a pivot point within the base. But generally speaking, we're within 5-10% of a high. All right, you want to be fairly close to the high. You don't want to be down and buying a stock that's 50% off its highs. Now you've run into that problem. You have lots of supply, right? So what you do is when you're looking at these pivot points and you're looking at the supply to the left, supply is always to the left. You're basically looking where the majority of the price action has taken place, where the majority, now you can see right here, almost all this price action has taken place right around the 17-ish level, right? So this is tightening up right there. That's exactly what we want to see. We want to see it quiet down right at the area where you've had a lot of the price action. And as you get further away, you've got some price action above here. And so that's not really supply, because it's a good distance away. It's in the 9-10 months away. And it only traded above that level for, I don't know, maybe a month, 20 days or so. So the combination of not being above there very long and being far away makes that supply less of a problem. The closer the supply and the deeper the correction, the more that supply is an issue. That's a general rule of thumb. Okay, so let's show you another one. So this was BB Stores, 1998. I bought this right here. This was a big winner for me. Came out real nicely, just took off. I remember it was like right off the hop. It was blasting off. You can see here. See how explosive comes right out. 1, 2, pauses for a day, 3 days up, and just it's very efficient. Alpha, just all alpha here. There's almost no volatility whatsoever. The upside far outweighs any downside or pullbacks. But you had to go through this nice long base here and form this perfect VCP. And here's where you got the volume contrast. You got another little one right here. There's your pivot point. You got a pivot point here. You got one here. So you got all these opportunities to buy. You buy here, you can buy here. You can, maybe you bought it and sold it, and then you bought it again and sold it, bought it again, or you add to your position. You know, if you're trying to make a really big gain in a stock and you really believe in the company, the fundamentals are coming through. That's more of an O'Neill type approach of adding to it on each base during a bull market. This is where you would be adding. But the key to look at here is what I call the 1-2 punch, where you have the low volume and then the volume comes in, and you're only going to know that in hindsight. You're at the end of the day, you'll see the volume, or maybe the stock breaks out at 10 a.m. and what you'll look for is you'll extrapolate. You'll see what kind of volume is trading. Maybe after it starts moving, you see what's traded in the first couple hours, and then you can divide that by how many hours in the day and get an idea of sort of what the run rate is.
Just to point out too, Mark, on that slide, that first buy point, you can see, you get what Mark refers to as the 1-2 punch, where the volume comes down, okay, it's really low, and then you get that volume coming in. But to the prior point we've made a few times, those are institutions. If you look at, you've got 3 out of 4 days then up on really nice volume. And this is something, people ask every now and again, well, if we all buy together today, we can break the stock out, right? But we can't keep it broken out. That's where the institutions, when you see, how many above average blue bars after that first breakout do you see? 1, 2, 3, 4, at least 5 in the first 2-3 weeks. That's those institutions. They're creating this whole trend that, again, back to our analogy, the aircraft carrier is creating this really nice wake for us that we're riding.
Yes. And we're going to get later on, we're going to talk about not only are we talking about the buy point here, we're going to discuss exactly what to look for after the stock moves to the buy point to determine whether the action is normal and whether we're seeing institutional footprints, or if it's abnormal and the breakout isn't that strong. We'll be looking at that. That's a little bit later. Actually, I think it's coming up next, actually. And again, really important to determine whether you've got institutional buying or retail buying. Like Mark just said, retail buying can budge a stock or move it short term. But the only thing that's going to keep a stock really going and hold it up is persistent buying by big institutions. And those are the backs that we're looking to ride. Let me show you some more examples, and then we'll come back to that concept. So again, here's the 1-2 where you get the contraction in volume, right? You can see really volume comes way down, way down here, and then bang, real strong volume expansion as it goes through that pivot point, very, very tight. And again,
that's a great example too, right there, Mark, how tight that is. You should know very quickly in an example like that whether you're right or wrong within a day or two.
Yep, I remember this when this chart came up. I got very excited, and I was actually looking at it over here where it started tightening up, but it didn't break out. So then it came in a bit. It had to go through another iteration, and then finally it tightened up here. The volume came way down, and I bought it right there coming out. Now take a look at that chart, and then you take a look at that's New Oriental Education, and then take a look at Melly here. Very similar. Very, very similar, where you got real tight here, and there's the 1-2. There's the contraction, and the volume starts coming in, and again, 75% in 13 days. See, to me, that's a super performer. That's what I want. I want a stock that goes up 50, 60, 70, 100% in a week or two, or even in a month. I can string those together and make a huge return. So also you want to think velocity, not just magnitude. A lot of people say, well, you do a lot, you swing trade, and they read about me or they see me on Twitter, and then so we're looking at all these stocks that made 50,000. Another one here. There's the 1.2. See the volume? You almost can't see it on the chart. It's the lowest volume in the entire. It looks like almost in the entire history of on this chart, but certainly in the base, it is the lowest volume. It is not a coincidence that the absolute lowest volume took place the day before the stock exploded.
Mark, just to point that out too, you can see this is a really good example. This is one of the best examples of the towel getting wrung out so dry, because you can see the volume that came in wasn't that huge, but look at where it takes the stock. It's because it got wound so tight there on the right side. Maybe average volume then, this stock's 60% in 17 days.
It's a great point. What Mark's saying is that look at this volume through this whole move. It's not like it's this gigantic volume that took place. So again, that tells you that there's very little supply, because it didn't even take a tremendous amount of volume to move the stock. So again, you're sort of like getting double coverage. When there's no supply, even a small amount of volume can take the stock up. But if you've got big volume, then it could be massively explosive. Let's look at another one here, because look at these, they're very similar. This last little part right here, where you get like a little mini uh, volatility contraction, and this is what we call fractals. If you ever heard about fractals, fractals are patterns within patterns. And if you start seeing fractals within a nice big base, that is a really strong sign. When you get a little VCP within a larger VCP, very good sign. And that's what you want to look for. You can see here, this is a fractal where you got the big VCP, but within it, there's a little VCP right here, right? And very tight here. There's the 1.2. Again, 70% in 3 months. See, we're looking at some stocks here that are velocity moves. Netflix, of course, went up a lot more. It was a secular leader. Same thing, the 1.2 punch with the volume.
Even there, Mark, that Netflix had a little bit of fractal on the right. That last little tightening there was a tiny little, little cup there on the right side.
A little VCP on the right side right here. You can see a little mini one within a larger, and it went through those various iterations. Shopify, most of you would know Shopify, nice and tight here, right on the right side here. You can see this had huge volume, big contrast in volume. That was the liftoff. Another thing that you want to make note of, and that is that you don't need huge volume to stay in the stock. All right. We're looking for that first liftoff. When you first come out of the base, that's where you want to see the volume, and it doesn't have to be on the day of the breakout. It doesn't have to be the day that it moves to the pivot point. It might come in 2-3 days later. As long as it holds your stop and the stock's acting well price wise, you stick with it, and you start to look for those signs, those institutional footprints over the coming days, and that's important. Again, we're going to get into that in a little bit of when we look at confirmations and violations. I just want to keep showing you some examples here, just to burn some of these in your head before we move on. Quest, yep, I bought this one in 98. Again, look at the volume, comes way down, and then we come out really strong here. Look how tight, super tight, and you go through these iterations. Look at, oh yeah, that's right, Nightbridge Tankers. This is one that, and you often hear Mark and I talk about how we stay away from sometimes the cyclicals, the oils. This is one that I actually stayed away from, but I was watching it and entertaining the idea of buying it. I did not, and it just blasted off. It was like a couple of weeks later, it was up 44%. I thought it was a good example. Now, you can get multiple buy points within the base, and this is, as we move forward, we're going to get into more and more expert techniques. Like in the beginning, it's going to be very mechanical. We're going to show you, a couple moving parts, but then we're going to get lower in the base. We're going to start look. There's other buy points, which we're going to get to in just a second here. And there's multiple buy points. There's staggering. There's pyramiding, and we're going to get into what I call more expert techniques, and that will build upon. You start with the with the basic techniques, and then everything builds upon those. So that's why I'm showing you example after example. I'm going to give you that foundation, and then everything is going to build. Remember what I said. Every single thing in this entire workshop builds on the previous. Nothing that I say in the current time frame erases anything that I said prior to that. Everything will build on what I previously told you in pretty much in chronological order. So now, again, you see there's a couple buy points here. I mean, you can be buying it right here. It tightened up enough, but it didn't really just take off just yet, but it stayed nice and tight, and the volume came down again. And you're getting that same 1-2 characteristic even on both buy points. You see, it didn't just take, like I said, it doesn't have to just take right off. It might have needed a little bit more time, a little more digestion, another twist of the towel to get some of that supply out. Once the supply's out, bang, then the stock can take off. Now, we do buy even lower. That's like, remember the commercial, wait, there's more? Well, we do buy even lower in the base. All right, there's 3 spots, which I'm going to show you. Just want to see, where is that in the chart? Yeah, it's coming up in 2 slides. There's a couple spots within the base. Remember I said everything that every stock that we're buying is within the base, within the VCP. Once the stock takes off, that's it. We leave it alone. Hopefully we're in already and we're enjoying the profit. But there is what we call the cup completion cheat, which is simply we refer to it as a 3C, which is cup completion cheat. It just means that, and I'll explain to you how this even came about. Back when I first started looking at charts and so forth, like many of you, I read O'Neill's book. I subscribed to Investors Daily, and the matter of fact, I had the very first Investors Daily that ever was printed. That's how early on I was reading Investors Daily and reading O'Neill. And of course, I read about the cup with handle. I read Giller's book about the saucer and platform. Discovered that that's where O'Neill got it, and he retermed it. Started looking at applying it and started using those techniques of buying cups with handles. And a friend of mine, we used to talk. He was a stock trader. We used to talk on the phone all the time. And I started recognizing that there was a little handle phase or pivot point, like we're talking about today, that was forming lower. It didn't have to be way up by the high. We were looking at stocks that were making new highs most of the time. I noticed 5-10% in the base, in the mid portion of the base, there was this pivot point that would form very often. And what happened was it would come up the right side and it would pause, and then I would say to my friend, I would say I cheated. I bought before the stock fully set up, and I cheated. So he said, well, that's where it completes the cup. Like, that's the completion of the cup. When it completes the cup, it forms that little pivot in the lower area, and we can buy it there. That, I think that's a safe place to buy it. So we started buying there, and that's how this term was coined, if you will. So here's how it looks. And this was a stock that actually, this was on my very first blog, right, Mark? You remember this?
I remember this one very well. Yes. This stock absolutely blasted off too.
It did, yeah. I started a blog. Someone told me to blog, and I started blogging back in 2000. I think it was around 2010. And the very first stock that I put on my blog was this stock, but it was at this point right here. It was right before this took off, and I bought it. I bought the stock right as it came out here. But there was a buy point previous, where we call the cheat. Right here would be the cheat, where as you complete this bottoming phase, now I could have bought it here. I could have bought some here. But then it tightened up even more, and it got really tight. Look how tight these 2 days are, and look at the volume. See the volume right here? Again, this is not a coincidence that the day before the stock explodes and then went on, it just took right off too. That's the lowest volume. It is like pretty much the lowest volume in the entire base for sure. And almost all this lowest volume or second lowest volume. It's no coincidence that it's happening on cue like that. That's because the supply stopped coming to market, and now that demand comes in and it just explodes. Happens time and time again. This is timeless. You can go back and look at charts from 1896. You'll see this exact same thing happening over and over and over and over. So here are the three potential buy points. So the three buy points that we will try to get on in an emerging stock. So the stock's in an uptrend already, right? It's already in a stage 2 uptrend, and now it goes through a pullback, a correction. Let's say it pulls back 25%, starts running up, coming up the right side. Well, that first pivot point, which we call, and I haven't even showed you the load sheet yet, but that's next. So the load sheet is actually even lower than the cheat. The cheat is in the middle third, the handle's in the upper third, and the load sheet is around the bottom third. And that gets even more expert, which we're going to get to in just a second here. Let's move forward because we looked at this chart. Let's go up to, okay, let's look at 189, page 189. So this is Baidu. So again, you see the cheat here? So you've gone through that volatility contraction. You've contracted here. Now, as long as the tightness, the price tightness in that lower pivot point in the middle third of the base, as long as it's in single digits and the volume's contracting, you can buy it there. You can buy it there. And sometimes when things are ripping and the market's doing well, we put our whole position on right there because sometimes it doesn't even set a handle. It comes out of the cheat and it just takes off. So this is, think of this as, if this was the 10th floor to get on and we're looking to ride the elevator up to the 30th, this maybe is the 5th or 6th floor, right? And this is the bottom. This would be the basement right here. So we have these various techniques to get on board up that right side. We want to get on board as that stock is heading towards those dots. And we want to get on board somewhere up that right side. So we have these various levels that you may get a cheat, you may get a handle, you may get a cheat and a handle, but you very seldom, a stock will go through, will form a base in an uptrend, a strong uptrend, and go through this BCP, these iterations of tightenings, and you don't get at least one of them. So you'll get these opportunities. Let me show you a couple of others. So here's Microsoft. I was buying right here, coming out right here, and then it formed this handle, if you will. You got a follow-up buy point, so you got a couple. You had the cheat, and then you had the handle. Take a look here. So this is one that doesn't really form. This is sort of, right in the middle. So you call this the middle third. I would call this a cheat, but then it just comes right out. It doesn't form a handle or an adjacent pivot point. It doesn't really matter what you want to call them. It's just simply pivots that set up in the lower third, the mid third, and the upper third are what you're looking for. And the lower you get, when you get down, the lower you get in the base. The issue is that you have to be more cognizant of the supply to the left, because as you go down, you've got supply, right? When you're at the highest level and you're breaking to new highs, there's no supply. You cleared it all. All the buyers are happy. They're all at profits, and you cleared out all the people who had losses. So now the stock, that's why the stock's free to run. But when you're coming off the lows, you're going into that supply, and the deeper you are, the more supply there is. So that's why it becomes more of an expert technique. As you go down into the base, the cheat areas and the low cheats, you've now really got to assess the supply to the left correctly. All right.
Another example there, Mark, too, of I think it was 1 or 2 days before it came out, lowest volume in probably the history of this chart right there.
Yep, right here, right there, very low volume. Yeah, pretty much. Yeah, that looks like that's just about the lowest volume. It was maybe 1 or 2 days that were even close to that. So yeah, lowest volume. Again, no coincidence that the volume is drying up right before it takes off. So now here's one that you won't really get. It's pretty flat and tight to begin with. You get a shakeout here of the lows, comes ripping right back, and you don't really get anything, a low cheat or a cheat. It just forms a handle here. It's right up by the highs. So you don't get an opportunity for that. You only get one opportunity. Sometimes you get all three. You get a low cheat, a cheat, and a handle. And very often, and I know Mark does this a lot, he'll start off and start his position. If you get the low cheat, he'll start a smaller position, maybe a quarter of his position. Now it sets up another pivot, you add, and you maybe bring it up to 50%, a 20 or 75% position. And then as you form that final pivot point up around the highs, now you're working with some profits, and now you add to that, and now you get that average price somewhere in the middle, and that lowers your average price. Let me show you with the load sheet, right? The load sheet, I love to use the load sheet on IPOs, recent IPOs, which we call a primary base. We have a whole section, and we're going to talk about IPOs later. I like to look for the load sheets on particularly the big cap IPOs, the ones that are really, they're real popular. And then like Facebook came out, when it first came out, IPOs, it was all the rage. Everybody had to own the shares, and it just fell apart. LinkedIn was another one. These stocks very often will correct 50, 60% right off the IPO or shortly after. And then they'll give you that opportunity, that load sheet. And Google was one that set up, really quite perfectly, and never formed any handle, any other pivot. If you didn't buy it at this load sheet, it just ripped up right from there and just took right off. And of course, it went up over 600% in 40 months, but it went up a lot more than that, much further out. So here it is. There's what it looks like. Just in the first 40 days, it went up almost 100%. You had a double. So very, very efficient. Excuse me. Let me show you another one. Twitter was one that set up almost identical. And again, you get the IPO, and right off the IPO comes right off. Not a big correction. That's why this was a pretty solid load sheet, because you didn't have a whole lot of overhead supply to contend with. But in just 16 days, it ripped up 77%.
Both those examples, Google and Twitter, you can see too. Literally, the stock traded the lowest volume in the history of the stock in that little low cheat, because it only been trading for 3 or 4 weeks.
Yep, real low volume here. And again, you see the volume started to come in as the stock started to move. You didn't have to have the giant volume as soon as it took off. But as you started getting into new high ground, that's where the volume, and they really started to pile into it. Here's another one, CFLT, Confluent. I mean, these look so similar, where they're almost identical. And again, you did get a little handle phase here, if you will, and you came out and it stalled out a bit. But again, a perfect load sheet. Now again, you've got to assess where this is really dangerous is when the decline, if this decline was, let's say, 60% in 4 weeks, I would not be buying this. And if I were, I'd be buying a tiny position, and I would take very little risk, because there's just too much supply. So you've got to assess the supply situation. The shallower it is, the more you can play that load sheet with confidence, and maybe position size bigger. I don't know if you, Mark, I don't know if you have any general rules. Mark and I have never rehearsed for this. This is literally completely off the cuff. He hasn't even looked at the slides. So we're just, we're just doing this off the cuff here.
That point you made, Mark, is really important though, about, look, the bigger the decline, the more trapped overhead supply you're going to have. And, Mark always says, look for traffic to the left, meaning if you're figure this is a one-way street where we're looking left before we jump out. And even in this example here, it did stall out at the old highs there. Well, that's because, this is a little bit bigger pullback, probably, say, than the Twitter or the Google example. So it's just that natural, your trapped longs were probably getting out there before the stock then went higher.
I should probably have little cars right here driving this way, because it's a one-way street going left to right. So
exactly right.
You're crossing, think of it crossing a street. It's a one-way street. All the traffic is going to come from the left. So you're going to look at that, assess that supply on the left side. All right, let's move on a few more. You might remember Vroom, VRM. So this had some supply here, but it came ripping out quite nicely. Not much though. You see, you're only traded there for, I don't know, 1, 2, 3, 4, what's this, maybe 8, 9 days. You traded above that level. Not a very huge decline here. So not a lot of supply. Probably I did not buy this, but this is one that I probably would have been buying very lightly here, because it did have some supply. I did buy this one here, this ICPT. I bought it at both these points right here. I remember this actually quite well. It was actually a big decline. And I still bought it here because it was so tight, and it just took right off. And then up here, I got even more aggressive on it. Let's see, let me show you a few more, and then we're going to move on. Here's another one, very tight. You can see comes out, and look how efficient the move is. It just comes out very quickly. See, you don't want to be in all this. You want to be in this. This is the alpha. This is where you get lots of upside, very little downside, not much standard deviation. So there's not much volatility, not much standard deviation, and you get a lot of alpha. You might remember Tilray. We talked about this earlier, compared it to Macy's. It's a big company, and this was a small company.